Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand Forex, gold, and S&P fundamental and technical analysis for the week ahead starting the 7th of December. Hope you all had a great trading week, and let's get into the week ahead. And this is from tradingeconomics.com. So it says here, the Federal Reserve will have its final monetary policy decision of the year next week, taking center stage for global markets. FOMC members will also update their economic projections along with the rate decisions, with the federal government shutdown preventing any official data past September from being taken into account. Likewise, delayed releases will include the jolts up to October and Q3 employment costs. Key rate decisions will also be featured by central banks in Canada, Switzerland, and Australia. Meanwhile, China will post its November account, and both consumer and producer inflation prints. In Europe, a busy week for the UK will be headlined by its monthly GDP and trade figures, in addition to joining Germany in posting industrial production aggregates. So lots going on this week and into next week, which will probably be the final trading week of the year, as traders will take the Christmas holidays off, and that will be it for 2025 most likely. So only a couple more trading weeks left. And so let's get into looking at risk sentiment. And risk sentiment is always important because it really kind of determines where traders' kind of focus really is. And risk off is when traders are looking for safe haven plays. Risk on is when they're looking for more yield return strategies. So the VIX, although the VIX is a volatility index, is also a barometer of risk sentiment alongside stock market, gold, as well as treasury yields. Now, looking at treasury yields, you can see. The S&P. We can see, in fact, over the past month, we've just seen the S&P, bounce from from the 21st of November all the way up back up to these near all-time highs, right? And the stock market is seen as more of a risk on asset in terms of when the S&P is moving higher. That's more of a risk on sentiment, where you get drops in the S&P, quick drops and large drops. Then that's seen as a bit more risk off, and if the VIX is moving above the 20, that would kind of confirm that as well. So a bit more risk on, I would say, than risk off, and I say a lot more risk on than risk off. Gold, on the other hand, although this week did make some highs, went back to its kind of like all-time highs. I think that's more of a function of a weaker dollar than more risk sentiment at the moment. But we did get a bit of a move to the downside on the Friday afternoon, and you can see that also correlated to the 2-year Treasury yield. Now, 2-year Treasury yields kind of and the 10-year as well reflect interest rate expectations, and so there could be the potential with the interest, with the yields going higher. This could be signaling that although there are cuts on the horizon for the dollar, which we'll get into in a sec, maybe the market may think that there could be a bit of a hawkish cut coming in terms of future interest rates. So it could be like a one cut in December, but there might not be as much cuts coming in 2026. But we'll see what happens this week as well, whether it is a hawkish cut. But we'll get into that, like I said, in a little bit. But overall, we should see more risk on than risk off. And so then we can kind of focus on, again, yield return strategies like interest rate divergences, where central banks, you're buying central banks that are either hiking or holding rates versus those who are cutting rates, or just typical carry trade strategies where you're just buying the higher yielding interest rate over the lower yielding interest rate, right? So that's really the direction. So looking at the US dollar and US dollar index. And this is the equally weighted US dollar index. So it's the dollar equally weighted against the euro, the pound, the yen, the CAD, the Australian dollar, the New Zealand dollar, and the Swiss franc. And last week I was saying that I was definitely bearish on the dollar, and I still am to a certain degree. I'm not going to second guess the market in terms of rate cuts, although there is the possibility for a hawkish cut. I'm going to wait for the hawkish cut to happen before if I decide to, change my bias on, whether I'm going to be a buyer of the dollar. But there's a lot going against the dollar at the moment. So the first is obviously, rate cuts. The market is definitely pricing in a better than 80% chance of a 25 basis point cut. And really, the key takeaways is that, the structurally negative dollar, especially versus central banks that are on hold or hiking. So, for example, the euro, the yen, the Aussie, the New Zealand dollar, and the Canadian dollar. And Deutsche Bank, Standard Bank see December gloom for the dollar, and it says here forecasters warn of possible triple whammy of risks for the dollar in the coming weeks that could worsen what's already a seasonally weak period for the currency. And talking about seasonality, we have some data since 2000, really, the year 2000, and what the dollar um, as how the dollar has performed in average monthly returns in percentage wise against other currencies, right? And you can see here that really one of the strongest currencies against the dollar in December being the last column right here, is the Swiss franc. And so let's just put the pencil here so we can see in December, right? Swiss franc, Swiss dollar tends to appreciate. The euro dollar as well tends to appreciate. Pound dollar not so much. The New Zealand dollar as well does tend to appreciate from a seasonal perspective. And then you got the Australian dollar bringing in, the 0.75% as well. But overall, the dollar typically does have is weak seasonal in December, and has been since the year 2000. So that's like 25 years worth of seasonal data. So that's one thing going against the dollar. And it says here the greenback might be hurt by possible Supreme Court rulings. Second. Um, Supreme Court ruling, that tariffs are illegal, and the potential selection of White House National Economic Council Director Kevin Hassett as Federal Reserve Chairman. And he is seen as actually being very dovish. Donald Trump is seen as wanting to cut rates even more to kind of help the economy and businesses. And Director Kevin Hassett is seen as an appointee of Donald Trump, and shares the same, monetary policies. And so that is seen as potentially dovish. And it says a jump in the yen if Japan raises interest rates this month is also a risk, with a rate hike and other factors potentially causing the dollar to slide back to around Q3 lows. And so there's lots going against the dollar, which, of course, if you're a contrarian, is actually maybe some music to your ears. You typically want to go against the herd. But usually I don't go against banks if they're trying to, if they're in publications like Bloomberg. Reason being is because really their reputation is at stake. A lot of traders think they want to mislead traders, but most traders don't trade. Well, most retail traders don't trade fundamentals, right? And so ultimately, their clientele are people that are kind of high net worth, high end. And so if they're reading Bloomberg, and they're reading that Deutsche Bank and Standard Bank and the banks are always saying that they're short, and then price goes up, and then they're either long and then price goes down, then of course for their clients they're not going to be happy with that, right? So ultimately I think that if I'm going along with I'll be obviously more inclined to go against retail, but I'm trading along with the big money, the smart money. So and it makes sense just from a fundamental and data perspective until, of course, that data changes. So for me, the path of these resistance still is to the downside. Even if you get a pullback on the dollar, I think right now, if there's pullbacks on the dollar, but the data doesn't show that, there should be some sort of structural change to the upside. There's definitely strong reasons why we could continue moving to the upside. Then my bias is really to the downside. Now, heading into 2026, the dollar actually starts to get stronger again in the first month or two of 2026 or the new year. So, of course, we could see some more downside, but as we go into next year, we could see a bit more upside. But again, that will just depend solely upon monetary policy, the data. And if the data is good, then of course I will change my mind on the dollar. But for now, my bias is still to the short side now. Am I going to go short at lows? Absolutely not. I'm waiting for a pullback before going short. So, but if you are looking for buy trades in anticipation of a hawkish cut, I think technically this aligns really well with that trade idea. A bit on the riskier side to go against the market, but ultimately risk is proportional to reward, right? So high risk, high reward, and so there is an idea that you can have that. You can look towards that trade idea, and technically that would actually be quite nice going into the week as a buy for the dollar. But my bias is definitely still to the downside. Looking at the European Central Bank, the euro. And at the moment, they're looking to hold. The base case is for a hold. There is a 70% chance of a hold and a 30% chance of a cut. But really, the ECB is seen as easing much more slowly than the Fed and the Bank of England. So the key takeaway of that is that stronger Eurozone data and central bank that is not in a rush to cut leave the euro in a sweet spot versus the dollar and the pound. And with positive seasonality and improving industrial GDP prints, I pasted euro dollar is still has room higher, especially if the Fed messaging next week leans dovish. So ultimately, looking at the eurozone, says here the eurozone grew more than first thought on domestic demand. So euro area economy expanded more than initially reported in the third quarter, thanks to boost in investment and consumption. So positive news coming out of the euro, and for me, I think ultimately the euro remains on the buy side. It has dipped down a bit, which is fine for me because, of course, you always want to be, you want to buy low, sell high, right? So we've come down into actually a really nice demand zone, the bottom end of that demand zone. And so looking for a buy is what I'm doing on the euro. If it comes down even lower, even better. I'll look for a buy down here. No real reason to kind of sell the euro at the moment. Data is really kind of supporting the euro for buys overall. Looking at the yen, and the yen is a bit of a strange one, really, because you've got a bit of a hawkish central bank, but fiscally the government is quite dovish, and the impact of the fiscal policies is kind of counter to the Bank of Japan. So at the moment, it says here that the market is implying a 60-65% chance of a 25 basis point cut. The market's now pricing in a slow hiking cycle. And the key takeaway to this is that, this is the big structural shift. The Fed, the Bank of England, the ECB cutting or on hold while the BOJ is hiking. Combine that with Fed cut next week, and that normally typically usually leads to a weaker dollar, and the Bank of Japan hike on the 19th, but the probability of one usually leads to a stronger currency, right? Hikes should lead to a stronger currency. And it says you get bearish and you get a bearish dollar yen story into the year end, even if positioning and risk on episodes cause bounces. And the yen looks well placed to outperform the pound, Swiss franc, and possibly the euro over the next few months. But again, what, based on monetary policy, you would think so, but the only thing is that what's really kind of hurting the yen is just the fact that the fiscal policies. And here was an article. It says here yen strengthens as Bank of Japan is likely to raise rates this month. And on the morning of the 5th of December, which was the Friday, the yen did strengthen quite a bit. It says Japan's currency rose against the dollar after reports that the Bank of Japan officials are ready to raise interest rates this month. Yeah, it says here key members of Prime Minister Sane Takahachi's government wouldn't try to stop the BOJ if it decides to raise rates in December, according to Bloomberg. So, I mean, it doesn't, well, that's actually quite positive, not necessarily, the government or certain government members aren't necessarily opposed to the Bank of Japan. So, from a sentiment perspective, Bank of Japan, maybe has a bit of support from members inside the government. That is positive, but it just still seems like the Bank of Japan is still, or the currency is still struggling a bit. But the way to look at it is, again, buy low, sell higher, right? This is probably, if we're going to go any higher based on the Bank of Japan hiking rates, then this is actually a really nice buy, right? It's difficult sometimes for traders to look at this kind of price action and want to buy because, of course, there's things like the trend is your friend and sayings like that, but ultimately value shifts eventually. And so this could be one of those moments where, although yes, in the short term we're seeing prices move to the downside, who does a lot of buying when retail is bearish, right? The smart money, so they can just keep buying at these lows, and eventually they'll stack up iceberg orders, etc., and then prices can move to the upside. Now that's not to say that prices can't move any lower. um, the yen is also dependent upon what the strength of the yen is dependent upon what the Federal Reserve do as well. And if the Federal Reserve are hawkish, then that could still drive the Japanese yen down a bit further, right? But typically, a rate hikes are normally supported for a currency, so this could be the baseline before prices at least move up. Towards these supply zones at least, and may want to test these. So I do think that the yen is a bit more of a buy than a sell, but more of a cautious buy at the moment. Moving on to the pound finally, and the pound index. The pound, a lot of traders have been expecting the pound to kind of sell off, including myself, and it did kind of sell off. And then we got this, large bullish day. But I was saying to the traders in the group that I think that this is probably the ceiling, the limit to the moves to the upside, and I've proved to be right so far. But there's no real reason to buy the pound, in my opinion. The Bank of England are looking to cut rates, so we've got here that the market implied 3.75%, a full 25 basis point cut now is 100% priced, and more cuts priced through 2026 at the moment. And it says here that the Bank of England is now squarely in the early active cutter camp alongside the Fed. That aligns with the bank research that I quoted. Any pound strength is likely to be sold, especially versus the euro, the Aussie, the New Zealand dollar, and the yen. And the euro pound and Aussie pound still have upside as long as UK data stays soft, and that's really the key. And Bank of England keeps guiding to more easing, so that's really the key, right? It's always the data needs to support the narrative. If the pound pound data comes out and it's strong and supports less cuts, then of course you have to change your mind, right? I have to change my mind on shorting. But for now, I think the government policies, which are going to be really kind of going to be applied in or take effect really from April. I think leading into that, maybe the market is definitely more short. I've read some other bank opinions and analysis that they're kind of short on the pound as well. So I'm going to continue to remain short on the pound on pullbacks regardless. And actually, I did get short on the pound CAD, which again I'll talk about a bit later in the new trades section of the video. But for me, yeah, the pound is a sell. There are cuts coming, and it says here as well the Bank of England to stop rate cuts at 3.5%. The OECD predicts. So there's definitely cuts coming, but maybe the OECD thinks there's probably going to be two rate cuts. And it says the Organization for Economic Cooperation and Development said the Bank of England will cut rates twice more to 3.5% by June before monetary easing ends. And there is some bit of positive news. The OECD upgraded its UK growth to 1.2%. For 2026 has projected 1.3 in 2027, making the UK the third and fourth fastest growing economies in the group of seven. Now, that does sound quite positive, but I think that would be after the effect of rate cuts, because really rate cuts are designed to support the economy. And I think in the short term, rate cuts do or typically do have the effect of weakening a currency. So I think once the rate cuts maybe stop, and then we probably see the effects that has on business, then possibly the UK could be a buy if it is positive in terms of the economic data after rate cuts. But leading from today now into new year, the next month or two, I think I'm definitely more on the short side. So it says here the OECD revised down its inflation forecast next year, and again that helps rate cuts because of course a lower the more inflation goes towards the 2% target and potential overshoot, then you typically get rate cuts happening, and that's what's happened with other central banks. And said the current elevated rate would prove transitory as higher taxes squeeze growth and lift unemployment. So, again, in the short term, government policies, higher taxes are sure to hurt growth and lift unemployment. But again, that's why I said I think that the cuts are more kind of to counter maybe what sounds like the fiscal policies of the Labour government. But all that really means is for me is that I will continue to look for short trades right on the pound, regardless of how higher it goes. Just look for some shorting opportunities around here. So what does that mean for pairs, right? As a recap, for me, I'm going to be short on the dollar, long on the euro, long-ish on the yen, and then more short on the pound. So then when you're looking at pairs, it's easy to say, all right, if I'm long on the euro, short on the euro dollar, I should be long euro dollars, right? That's how you kind of mix them up. So when it comes to the pairs, euro dollar makes sense to be long if you're looking to buy the euro. The euro is in a cheap place, so the euro here is cheap. But the problem is that the dollar is also on the downside. What you really want to see is if you're looking to buy the euro dollar, you want the currency that you want to buy to be on the cheap side, which the euro is, but you need the dollar to be on the expensive side. So the dollar really needs to be here, around here, and then when you go to the euro dollar, if there's a setup that you're taking where you want to be a buyer of the euro dollar, then that makes all the sense in the world as confluence. So so now at the moment there's no setup, and so I would still think the path of these positions should be to the upside, whether it breaks out to that way or it goes to the downside a bit and then moves to the upside. Who knows? But ultimately it's just the direction of travel should be to the upside, and of course you need the data to kind of confirm that, right? Dollar yen, again, same thing with the dollar yen. If the dollar the Fed decide that they're a bit more hawkish, then of course you want to be long on this, because I think it's going to take a lot of traders by surprise if they are a bit on the hawkish side. But if they remain on the dovish side and data shows that there were more cuts coming, then of course we should see moves to the downside. And on top of that, if the Bank of Japan start to get their hawkish tone in gear, then of course we will see. We're likely to see anyway prices continue moving to the downside. Pound dollar, so the dollar strength, dollar weakness is of course driving prices to the upside. Not a pair that I'm interested in, but if you are, then of course you have actually a decent opportunity to get involved in this to the short side. Again, you have a bit of an expensive pound at the moment, and then you have a bit of a cheap dollar, so that makes sense if you're looking for short trades around here. But again, you'd have to be bullish on the dollar, bearish on the pound in order to get involved in that trade there. There is a demand zone, so if you are looking for buys on the pound against the dollar, the first area to look for a buy trade is going to be around this 13212 area. The euro pound, and I was looking to get involved in this week, but didn't do so because the risk reward just wasn't there for me. My entry would have been somewhere around here after the candle I was looking at closed, and yeah, the risk reward just wouldn't have been worth it. So didn't get in the euro pound, although I am definitely bullish on this currency pair. And so again, setting up, actually set up quite nicely. You have the euro, which is on the cheap side, right? And then you have the pound, which is on the expensive side still. Well, actually, that's the pound dollar, sorry. It's the pound index, right? So ultimately, the euro pound does look like a decent buy in this demand zone. So that's really looking at a potential trade setup on that as well. Although I didn't get into the euro pound, again I got into the pound CAD, and again I'll talk about that trade towards the end of the video. But if you are getting involved in this trade, then I think probably now is going to be the time, as I think this is a really nice technical level to look for some long trades. Euro yen, and again you're seeing really a bit of a range, bit of an auction, prices moving sideways. If you are looking to get involved in this pair, I'm not really looking to trade this, but I'd say you're looking for either short trades there, buying the yen, and you're looking for long trades there if you're buying the euro. But again, not really a pair I'm interested in, as both currencies in my book are, buys to different degrees. So you want to really look for currencies that you're looking to buy and one looking to sell for the best divergences and to kind of ride those trends. And then you got the pound yen. Now the pound yen, I'm still in this trade, which I'll talk about again towards the end of the video. But still in this trade, haven't been stopped out. Managed to actually profit off one position, so I've got one position open. But if you are looking to get involved in this and looking for short trades, the yen being potentially being a stronger out of the two, and the pound rolling over, then of course this is what should really happen to the downside, right? So let's see what that second position does, but again I'll talk about that a bit later. And we've got precious metals, and so gold continuing to kind of grind a bit higher. Not necessarily this week. This week's not been the greatest week for gold, but ultimately a weaker dollar should drive gold higher. But silver, on the other hand, has been, magnificent, right? And that's really kind of due to, it says here, silver, copper eclipse gold as top metals bet on supply fears. So it says here, silver has nearly doubled this year due to a historic supply squeeze in the London market amid surging demand from India and silver-backed exchange-traded funds. Silver has outpaced gold of late, gaining more than 11% to a fresh record, while copper has climbed almost 9% and is approaching an all-time high. Institutional and retail traders are positioning for record rallies in silver and copper, with implied options volatility and trading volumes increasing amid expectations of supply shortfalls and growing demand for electrification and clean energy projects. So it all sounds positive for silver so far. And so again, if I wanted to be a buyer of silver, I'd have to really wait for a decent pullback. Never want to be a buyer at highs. Of course, prices could go higher, but yeah, I'm not really looking to buy at highs. I need at least a decent pullback before getting involved in silver. But the path of these resistance should continue to be to the upside. The indices, again, spoke about at the beginning of the video, and making, of course, approaching these new all-time highs. And there's a headline that says, what bubble asset managers in risk on mode stick with stocks? So again, as I was speaking about in the beginning of the video, where we analyze risk sentiment, traders typically will adjust their strategies depending upon risk on and risk off. And it says here, global asset managers expect solid growth and easier monetary and fiscal policies to support a risk on environment in 2026. More than 3/4 of the allocators are positioning portfolios for a risk on environment through 2026, with a focus on equities, particularly in emerging markets. Now, that actually also is quite bearish for the dollar if these asset managers are positioning for emerging markets, because emerging markets, if you're buying emerging markets, then usually the dollar doesn't do well in that environment, as investors looking for more of a higher yielding asset than the dollar. And it says here, investors are optimistic about the US remaining the engine of the rally, but also see opportunities outside the US, including in India and other emerging markets, as well as small cap stocks and healthcare. So although the economy might do well, the US dollar itself may still look to weaken, over the next few months. But ultimately, risk on would mean that the market should continue to actually, creep higher and even break to new highs. And if you are looking for a buy on the S&P, then really you have to probably wait for some sort of pullback, decent pullback, before going long on the S&P at the moment. Doesn't seem like you can kind of get in at the moment, but yeah, we'll see. But for me, I'd look for any kind of buying opportunities to around these lows, and we do get we'll kind of remain in that risk on environment. So heading to trade updates and looking at actually a new trade I took. It was the pound CAD, right? The pound CAD was really the trade of the week. The only new trade that I took this week. Took some profit on the Aussie dollar on the Friday evening, and that trade has actually worked out really nicely too. And so to kind of break down this trade, fundamentally, I want to be a buyer of the Canadian dollar anyway, and a seller of the pound. And so the reason really for this move to the downside was because we had it says here, the loonie rises most since May as yields jump on strong jobs data. So that was really the data. The Canadian dollar rose the most since May, and yields on the nation's debt jumped as surprisingly strong employment data triggered bets and the Bank of Canada will raise rates next year, right? So we've gone from a cutting cycle to now a potential hiking cycle. But before that, all kind of played out. I did in the group discussion room, in our group private members, I did say to everyone on the 4th that if you're interested in going short on the pound CAD, here's a very nice stop hunt setup that ticks all the boxes, and it hasn't necessarily closed as a stop hunt then, but it was definitely looking like one, which it did turn out to be one. But there was multiple ways you could have got involved in this. It wasn't just a stop hunt. In fact, it was actually a nice supply zone trade anyway. So again, breaking it down and really kind of where I got involved in this. So my initial entry was actually here, when prices kind of came down to around this entry here. This price here, the 86, it was the 1.8604. That's where my entry was, my initial entry was. And I broke this trade actually up into 4 to see if I could get in a bit more positions, because I was actually quite hawkish on this trade. It was in the hawkish on the CAD. So what I did was I divided my whole risk up into 4 and had a position here, original position there, market order, and then just some sell pending orders as we went higher and higher. And prices, as it pulled back, triggered me into a second position, which hit my 1-to-1 target, right? So if I enter into 2 positions, one of them's got to hit a 1-to-1, and then I'm pretty much, at break even or a profit, depending on how many, if I increase my position size or not. But this trade ended up being, I didn't increase my position size on this one. I actually just had them as the same position. Position sizes. So this one ended up being hitting a 1-to-1 target, and so then I've only got this position on the market, which now is currently at about a 1.95 to 1. And so this is one I'm going to definitely try to look to hold. Maybe not into Christmas. I want to probably take the majority of the profit off, maybe have a little position on. But if we can go down a little bit more, then I think I'll probably start taking some more profits off the table. And really the area that I'm looking to take profit, I think, is going to be around maybe the 80% area of that auction. So not too far away. So if prices come down to here, then I'll take about 75-80% off of my trade, and then I'll just leave about 20% on, and then see where it goes. If it can go lower, then brilliant. If it doesn't, then not losing anything. The trade is an overall profitable trade. So that was the pound CAD. And then trade updates, the pound yen I took the week before last in last week's video. You can look at the analysis on this. It hadn't quite played out at the time because prices were up here, and then on the Monday, prices opened. You can see that I got into 2 positions. So this position here, I only entered into 3. We'll try to enter into 3 positions on this one. And you can see here that when prices pulled back to here, managed to get involved. And then that trade hit a 1-to-1 in the early hours of the morning. So that was nice. But so I'm only in this position now. And so this trade, my stop loss is still in these around this high here. So I'm going to see where it goes, and I'm trying to throw my stop down if it can break below this area here. But for now, this trade is profitable. So let's see what continues to happen on this. I'm hoping that of course, the pound rolls over and the yen gets a bit more stronger. And then finally, the Aussie dollar, been in this for a couple of weeks now, since the 21st of November. So again, you can go back to that analysis, that weekly analysis on that weekend, and I break down this trade. Got in on 2 positions, managed to get in on that pullback there. Managed to hit a 1-to-1 target on the 50% retracement, and then on the actual market order, this one on the Friday, prices were actually close to my profit target. And heading into a Friday, of course, I wasn't necessarily expecting, much moves or prices to really go much higher. So I was only a few pips away from my ultimate profit target of around 80% of this overall range or auction, from this high to this low. And so I just decided to just take 80% off of my profit target. So overall, the trade on that one was like nearly a 4-to-1. Ended up being maybe about a 3 point. So I took profits off maybe somewhere around here. So 3.89 to 1. Took about 80% off of that. So now I have 20% of that running, and I've trailed up my stop as well. So I think it's somewhere around maybe the 6,550s, somewhere around here. So yeah, locked in that profit anyway, and I can't lose. So even if prices come down and stop me out on the remaining 20% of this position, my stop loss is here. My original entry was down here. So ultimately, I'm still in decent profits. So yeah, those are really the trades for the trades and trade updates. So one trade last week, pound CAD, profitable trade. And then the updates, the Aussie dollar was a nice profitable trade. The pound yen, still just waiting for that to kind of roll over, but still in some profit at the moment. So yeah, that's it for this week. Hope you enjoyed the analysis and found it useful. Don't forget to like, subscribe, and share the video across your social media platforms if you find this useful. So yeah, take care, guys. And I think next week will be the last week that I will do the videos for 2025. So I'll see you next week. Take care. All the best.